Hey there, everybody. Welcome back to another episode of the Caderna podcast. I'm your host, Brian Caderna, and thanks for joining us. So, today we're going to go back to one of the first tenets of financial planning, which, of course, is protection first. And in that vein, we're going to be talking about life insurance. So, I know some of you tuning in right now might say life insurance, that's that morbid topic that you just kind of want to get done and out of the way for your financial plan. And I'd like to remind everybody that it's called life insurance, not death insurance. And it doesn't need to be such a morbid standpoint within the realm of financial planning. There are ways that you can incorporate it within the plan so that while you're alive, you can actually enjoy and see the value within it. It doesn't need to be just something that you put together and God forbid something happens to you, then your loved ones are the only ones that recognize any benefit. Okay? So what we're going to get into in particular is the common debate of term insurance versus permanent insurance. Is one better than the other? Is there a good or a bad? Should you have a little bit of both or maybe none at all? So that's what we're going to be discussing in detail today.
The Caderna Podcast.
The Caderna Podcast.
Caderna Podcast.
But as a history buff, I always like to kind of go back to the genesis of the particular product or strategy and see where did it all begin. So our first knowledge that we have is actually all the way back to 100 BC when Caius Marius of Rome created what was perhaps the first life insurance company. And what they did is within his community, they created a burial club in which all the members of the community would pay an annual or even monthly fee. We don't know the mode there, but they paid an ongoing fee so that if their loved ones in their household were to pass away, this club would then be able to pay for an honorable burial for the deceased. So it wasn't called life insurance back then, but if we look at what it accomplished, kind of the same goal that many of us set out for today, which is that once we're no longer here, how can we take care of our loved ones or not leave them with any burden financially? So I know that was thousands of years ago, and here we are in 2020 in this crazy year that finally we're almost done with. And let's take a look at kind of some of the leaps and bounds we've made within the life insurance industry. So now, like I said, just a couple thousand years later, it's an enormous industry. The statistics show us that there's currently about $19.6 trillion of coverage in force. What that means is that if all the insureds were to pass away today, $19.6 trillion of death benefits would need to be paid out. Furthermore, to look at the reality of that coverage and what actually does get paid, 2018, which we have the latest statistics for, there were over $290 billion of death benefits paid. So a lot of people wonder, I pay for this all the time, but does it ever actually return a yield to myself or my loved ones? And there you could see just in 2018, the death benefits paid out a staggering $290 billion from the insurance companies. So quite an industry. It's definitely gone a long way since Caius Marius of Rome. And in today, even just in America alone, there's over 800 life insurance carriers out there, all offering a slew of different products. So I know that it can get confusing. It might seem overwhelming at times. And that's why today we're just going to give you some general information so that you can make informed decisions and conversations within your financial plan. And along those lines, if you look at millennials, which we can't seem to talk enough about, 58% of millennials who did not have life insurance cited the number one reason why they didn't get life insurance was because they either A, did not understand the product, or B, weren't exactly sure how much they were supposed to get. And therefore, kind of paralysis by analysis, did not take action, and unfortunately were left uninsured. And of course, millennials being one of our younger and largest portions of the workforce, those are people who need to look at life insurance while still young and healthy, yet building quite an economic value to either their business or their family. So why don't we first start talking about how much life insurance should you have? So within the industry, there's what's called a human life value. And what that's defined as is the economic value that you're bringing to your household. God forbid something should happen to you today. And so the way that the industry determines that is a factor of both your age and your income. And so if we look at people between the ages of 18 to 40, the way that that's generally determined is going to be 30 times income. So let's say that we have a 30-year-old male that's making $100,000 a year. All right, so then 30 times 100,000, their quote-unquote human life value would be $3 million. And I know for some that might sound like a very large number. Like, wow, that's what I need to leave my family or my spouse. They'll be better off with me dead than I am alive, at least financially speaking. But if we actually look at, the cost of life over time and taking care of a family and a household from 30 all the way to about 65, all right, we actually realize that that number is quite large, and that $3 million figure it doesn't go as far as one might think, and that they're completely spoiling their loved ones. And then that factor to compute human life value, the multiple of income gets lower and lower as you get older. Okay, in your 40s or 50s, now instead of 30 times income, you may be getting to maybe 15 or 10 times income. And then eventually graduating to just folding it into a retirement or estate plan. Okay, so that's a little bit about human life value. And I usually tell clients or anyone I'm speaking with that you want to start there. And the reason being is that it doesn't matter what type of product you have or what name it goes by. If something happened to you tomorrow, you want to know how much would your family actually receive. Okay, we could have a beautiful product with all these different guarantees, bells and whistles, but if I'm a 30-year-old male with a family of 5, let's say, and something happened to me tomorrow, it doesn't matter what the name is. $3 million of coverage being paid out is far more effective than $250,000 of coverage paid out. That might be able to only get us through the next couple years or so as a family. So start there with human life value. The next step is going to be, well, what are these different products? How do we actually, fit the solution with the product? Okay. So we'll start with term insurance because I think that's what most folks think about when they consider life insurance. In term, which is synonymous with temporary, is going to purchase a death benefit for a specified term. Usually you'll see a 10-year, 20-year, 30-year product that says, okay, you pay your premiums on time for 20 years, and God forbid something happens to you within that period, your family then collects on that claim. So a lot of folks will equate that to essentially renting a death benefit, where we know that we have that for that term, but then once the term expires, then so does our policy. And so if we look at the current actuarial statistics, let's stick with this arbitrary 30-year-old, and assume that he's in pretty good health. Okay, so what the industry would call a preferred non-tobacco rate. Statistically, that 30-year-old has about a 99% chance of waking up at the age of 50, okay, and living thereon. So if we know that and we just bought a 20-year term policy, then we have the assurance that 99% of the time, people like that 30-year-old who's in good health will live beyond 50, and essentially that money, those 20 years of premiums, is squandered. We no longer have that. So that's where that renting concept or comparison is often derived from. But what we want to understand is, sadly, 1% of the time, that population will not make it to age 50. And for that 1%, that may be the most important financial decision they ever made to buy that policy. So like anything in life, and certainly here in the financial realm, we often say that cost is really only an objection in the absence of value. Okay? So you might say to yourself, well, 99% of the time, according to the statistics, there is no value here. I'm paying for nothing. But if we look at the cost of term insurance compared to the amount of death benefit, it is usually very dramatic, a small premium compared to the size of that death benefit. And so, yes, the probability of it being paid may only be about 1%. However, for that 1%, it can be of extreme value in essentially bailing out their family if unfortunately something were to happen to that insured. So that's the way we have to kind of look at that scenario. Very low likelihood of being paid, but one paid of extreme value to that household. So that's term insurance. Often a good way, an effective way, in a kind of cheap solution to that young family that's just getting started, saying, hey, I've got a lot of future, a lot of potential and obligations ahead of me. Here's an easy way to kind of put a band-aid on the matter and know that right now my family is protected. And for that 99% that might be saying, hey, it's kind of like a waste, I just paid for nothing, you can rest assured that they have attained a peace of mind that we can't really put an economic value on. Knowing that, yes, they are healthy, but unfortunately tomorrow is never guaranteed. And if something did happen to them, that their family will be taken care of. Okay? So hopefully we all do make it to that age 50 and we never get a death benefit, but it certainly gave us peace of mind along the way. So now if we kind of transition from this term concept over to, let's say, the permanent side, all right, there are a slew of products within the permanent insurance marketplace. But if we boil it down to the two most popular or noticeable, you would have whole life insurance, which was essentially the first type of life insurance. And then you have what's called universal life insurance, sometimes referred to as flexible premium life insurance. And within that universal life or that UL space, there's a lot of different kind of flavors and variations, which we won't get into too much detail today. But some of the names you'll hear are going to be variable universal life, indexed universal life, where now you're introducing a bit of a market component or investment component into your life insurance, where that is not present inside of a whole life product. So the way that the whole life product works, just to kind of start with that one, is you're locking in your cost of insurance at time of application. So whatever your age, your health, your gender are at that particular period that you say, I want to go get a whole life policy, you go through your medical underwriting and you get approved, and then you're going to lock in those costs of insurance moving forward for the life of that policy. So that's where you can have a guaranteed cost or premium for the duration of your life on that policy. And then what you're getting is a guaranteed death benefit, okay, a guaranteed premium or cost, and then you'll also have what's called a cash value, which is a form of savings, if you will, inside of that plan that you may access while you're living. So this kind of gives you that dynamic of having a family value through that death benefit and also a my value through that cash value that you can use while you're alive. All right, so it's kind of like a double-edged weapon there within your financial plan. Okay. And then the other thing too is both of those features, the death benefit and cash value, can grow each year, often at a guaranteed rate plus a dividend. Now, the dividend is never guaranteed. That's essentially a return of profits by that insurance carrier, but that's what can allow the policy to grow even quicker over time. All right, and again, there's a lot of different variations within the whole life space. Ultimately, you'll have some designed for you to pay your whole life, and then you'll have others that are called limited pay products that can be contractually paid up, maybe over 10 or 20 years or at a predetermined age, like age 65. So that you kind of have a window before you're kind of quote unquote paying off the product. All right, so that's kind of how whole life works. It's fairly predictable, again, assuming that you're making your payments and on time. On the other side, universal life now has quite a bit more assumptions or variables within it. The first is that cost of insurance is not guaranteed. Okay, so the actual cost or premium can increase in the future. And it doesn't grow via dividends. What happens is you get what's called an interest crediting method, which each year the insurance carrier can credit interest to your policy that then allows you to keep your policy in force while you pay your premiums. Okay. Now, what one does have to be careful of is these costs of insurance can go up. And if the interest credited were to go down and not be able to match that cost, folks can end up getting a notice later on that their premium has gone up, or that they may actually end up lapsing their policy. So there is a little bit of that risk involved. Now, I will say that Universal Life often has an option that the client can buy called a secondary guarantee rider, that will say, so long as you pay a certain premium on time every time for the life of the policy, they will guarantee your death benefit to a particular age, irregardless of how the policy performs or the interest that's credited. So that is kind of like a safety measure that you can add to a Universal Life product. Okay, so now what you're seeing is, again, and I'm not using this language, it's a common theme of going from renting to owning that you'll hear in the marketplace. When we go to these permanent products, we own it. We know that if we pay, again, our premiums and the policy performs as intended, that no matter when we pass away, whether at age 40 or at age 90, someone will be collecting that death benefit. Okay, so we've gotten that renting idea kind of out of the way, and we're also building a form of equity within that plan through its cash value. Again, dividends on whole life or interest on universal life. Okay, so often what you'll see people do is, based on budget and the amount of human life value that they need to achieve, then they'll say, okay, well, which of these products fit? If we don't have the wherewithal to afford a permanent product, we might have to go to term insurance. Okay, just like a young professional saying, I can't buy a house quite yet, but I need a place to live, so I'll rent an apartment. But a lot of these term policies can have what's called a conversion option on there that essentially reserves the right, by locking in your health, to convert to a permanent product in the future. So many people will eventually transition into a stage where they have a blend of term insurance and permanent insurance to satisfy that need, so that now we have the amount of death benefit needed for our family, but we're kind of segueing into this permanent space where we can guarantee ourselves more value over the long haul, either by having a tax-free death benefit paid out to our heirs that we know will be there, or having a cash value that we can enjoy, again, while we're alive. So some of the benefits there on the permanent side that I'd like to speak to. One, if we know that we're going to have a guaranteed death benefit available to our family in the future, and that can be income tax free due to the preferential treatment that life insurance benefits receive, that can become like a permission slip for us to use other assets within our financial plan and know that our family is going to never be disinherited, or that this big tax-free influx of capital can satisfy any other needs or desires that we had intended within our estate plan. Okay, so it can kind of free up the portfolio in a lot of instances to enjoy throughout retirement. And again, know that we're going to replenish the bucket for our loved ones. Then if we look at those cash values, okay, so now what these are is they're growing tax deferred. Okay, so we're not getting 1099s or anything like that along the way. And then if used appropriately, we can actually access that cash value later on in a tax-favored manner. Okay, again, due to the treatment that life insurance is afforded. So that's some of the benefit that you could realize within your policy. And so a lot of folks will start to get into that conversation of, all right, I understand them now, but should I start to get some permanent life insurance, or should I buy term and maybe invest that difference? Can that get me a better yield if we just start to look at the math of it? And the answer is possibly yes, possibly no. All right, they're very different products. And when we talk about insurance versus the markets or investments, okay? So I think that's where we need to understand what they do and then define our expectations. And if we're just looking at cash value, does it earn more than our investment account or our portfolio? Again, we don't know what the future holds, but we do realize that cash value, at least in a whole life plan, is quite a bit more stable than inside of the stock market. Okay, so maybe it's more comparable to something like fixed income. and also recognizing it probably receives much more favorable tax treatment than using money out of like an IRA or a taxable account. All right, so it's not that one is better than the other, it's that they're different. And often when we get into a financial plan, we want things that are different because we don't know what the future will hold, either investment wise or tax wise. So it's nice to have options so that in the future we can utilize whichever vehicles will be more favorable at that stage of the game. So I hope that this has helped. Again, we always like to keep it concise and try and give you some definitive info so that you can have a more informed decision in the future. And I'd like to finish with a quote from who's often considered the father of life insurance. That would be Eliezer Wright, a famous mathematician from the 1800s. And he said, "While nothing is more uncertain than a single life, nothing is more certain than the average duration of 1,000 lives." And that essentially is the foundation of life insurance, one of the most critical pieces within a financial plan. All right, so I hope that you've enjoyed this episode. We'll certainly touch more on it in the future, but please keep tuning in to the Caderna podcast. Leave us a review wherever you're listening or watching. Share it with a friend so that we can all become more informed on our journey towards achieving wealth in its original meaning, a state of well-being. I'm your host, Brian Caderna, and we'll see you next week.
The Caderna podcast is for informational purposes only. Individual situations may vary, and the information should be relied upon only when coordinated with individual professional advice. Guardian and its subsidiaries do not provide tax, legal, Social Security, student loan, mortgage, or real estate advice. Listeners should contact their own tax, accounting, or legal advisors or the Social Security Department in this matter. All investments and investment strategies contain risk and may lose value. Brian Caderna is a registered representative and financial advisor of Park Avenue Securities, LLC, Pass, 300 Broadacres Drive, Suite 175, Bloomfield, New Jersey, 07003. Securities, product services, and advisory services are offered through Pass, a registered broker-dealer and investment advisor. 973-244-4420. Financial representative, the Guardian Life Insurance Company of America, Guardian, New York, New York. Pass is an indirect, wholly owned subsidiary of Guardian. Caderna Financial Team and International Planning Alliance, LLC, are not affiliates or subsidiaries of Pass or Guardian. Caderna Financial Team is a division of International Planning Alliance, LLC, a general agency of Guardian. Pass is a member of FINRA, SIPC. California Insurance License Number OK04194. Content of the Caderna podcast is copyright of Brian M. Caderna, all rights reserved. Any redistribution or reproduction of part or all of the content in any form is prohibited without prior permission from the Caderna podcast. The views and opinions expressed herein may not be those of Guardian Life Insurance Company of America, Guardian, or any of its subsidiaries or affiliates. Guardian does not verify and does not guarantee the accuracy or completeness of the information or opinions presented herein. Any third-party materials referenced cannot be endorsed or verified by Guardian and are used as the opinion of the author. Guardian, its subsidiaries, or affiliates do not provide or issue or advise for mortgages. This material contains the current opinions of the author, but not necessarily those of Guardian or its subsidiaries, and such opinions are subject to change without notice.